what are the different types of mutual funds? Like there's open-end and closed-end. I'm not talking about that. I'm talking about like suitability, like whether it's a stock fund or a bond fund, the different types. So we're going to try to go into it. So my name's Ken Finnan, and I run Capital Advantage Tutoring, and I'm going to try to help you know the difference. No, that sounds like horrible English. I'm going to help you understand the different types of mutual funds, so you can, if you're taking the 7, that's great, or just in life, if you want to know what kind of one you should do, let's go for it. So I'm going to share some screens from various places where I got information from, and you don't have to read the whole thing, but I'm going to talk about what you need to know in each scene or screen, whatever the hell you want to call it, and then you can read it if you want. I'll try to put links in the video so you can go right to that stuff. But let's try to see what we can do and see if we can learn some shit today. So remember, we're not talking about ETFs, which I love. We're not talking about ETNs or closed-end funds. We're literally talking about open-end management companies, mutual funds, the ones you've heard of, the Vanguards, the T. Rows, all that stuff. So there's really two types, okay? There's two types you have to think of. There's actively managed, and then there's passively, which is index funds. We'll get into both. So actively and index, and everything falls under that. So actively managed means you're paying for some rich guy, rich girl in Greenwich, Connecticut to actively manage the fund. They're the active managers versus the index. So active is they're actively trying to trade, constantly looking at, trying to move the portfolio to respond to market events. So they actually have the opportunity to outperform what they're expected to do. Like if they're sort of tracking the large caps or what, if they do this, they could outperform the large caps, the index. Now they also can, if something shit hits the fan, they can react and get out of a position or move it around because they're actively doing it all day long. They're trying to outperform. Well, I'll explain how that's different in the other one. And they are trying to buy low, sell high. That's the real. But some of the managers actually try to make it so that there's less taxes. They try to do stuff on long-term basis so they pay less taxes. Because remember, mutual funds have to pay out 90% of their income. So if they make money, they have to pay it out, and it's taxable to you. So sometimes they try to minimize it. So the understanding is that if you're an active manager, the good things are you could outperform. You could react to bad news and change your portfolio to handle defense. And then hopefully they try to reduce the risk a little bit with taxes. They try to reduce some of the tax risk. And here's the bad stuff, right? So it's going to cost more. They have commissions. You're paying for this manager, the activity, all the research, all that stuff. You're actually incurring much more costs than a passive. Now, remember, if they're trying to outperform, they're taking on more risk. So there's a better chance of losing money. So that's what the bottom two are saying. Yes, we can outperform. We can actually underperform because it may not pay off. We're thinking something's going to happen, but it might not happen. So it can underperform. So again, actively managed is good stuff. They can outperform. They can react to bad news and maybe save you a little on taxes. I think that's the least of them. Now, the bad part is there's more fees, commissions, buying and selling. Maybe more taxable stuff have to happen. Because remember, when they're buying and selling, they're actively buying and selling, which creates realized gains, which are taxable. So that's an issue. And then they're taking on risk and they could actually do worse. So that's the pros and the cons of actively managed. Now, an index fund is they're not trying to beat the market. They're matching the market, okay? They may try a little bit to keep up with it, but they're mostly just matching the market. They're not trying to beat it. So you can have less fees, less trading and stuff like that. So first of all, they're lower fees, okay? 2, you're going to see what's in them. And unlike actively managed funds, you can't see on a daily basis what they have. But on an index fund, they don't change that much, right? Because they're really just passively changing it once a quarter. And I'll explain that they rebalance. So they have lower fees because there's not that much trading. They're transparent because they're tracking an index. You know it's in the index, so they have an idea of what's in there. And they're tax efficient, which is understand something. So an index fund, they buy and they don't change very much, maybe quarterly, maybe not at all. So if you have a thing called tax efficiency, so tax efficiency is not tax-free, tax efficient. ETFs are, common stock is if you buy and hold. Because remember, until hopefully nothing changes, right now they can't tax unrealized gains, okay? So if you ever make money and it's not realized, you're not taxing on it. You're not being taxed on it. So if you buy stock at 20 and you're 25 years old and it runs and it goes to 60, 70, 80, 90 and you never sell it, you don't owe taxes on that. That's what buy and hold does. It's tax efficient. You will pay tax when you sell it at a much lower rate because it's a long-term capital gain. So again, passive managers, they don't try to beat the market, so they don't really trade a lot. They buy and they match the index. They may rebalance it a little bit like the indexes do, but it's really not a lot of trading, so there's not a lot of fees. You know what's in there, and then the tax problems are not as big. Here's the problem. They don't have flexibility. So if the shit hits the fan, they got to ride. They're pretty much ride or die with the index. Okay. So they're limited to what they can do. Okay. They are limited. They have to follow the index. They can't change it that much. So they follow what's in the index and they go from there. And even if the market goes bad, they just have to stay with it because they're not allowed to be an active trader. They're just trading every quarter, maybe every year, based on imbalances when stuff gets out of whack. So they can't really reduce the risk. They can't protect you on the downside because they can't adjust. If they see the market going bad, they just got to go with it. So again, for an index or a passively managed fund, which is indexes, lower fees, you can see what's in it, and the tax is you don't pay as much as taxes. The problem is they can't change anything. So when things go bad, they can't take advantage of an opportunity. Like if they see an undervalued stock, they can't do anything about it. Where an active one can. Okay. And if it goes bad, they just got to ride or die with it. So that's active or managed. That's just the start. Let's get a little deeper into this. Okay, let's actually back up and talk about mutual funds for a second. So mutual funds, you buy into it, you buy it at the net asset value, you add a sales charge to it, and then if there is one, and you buy it from the fund or the sponsor, like you buy it from T. Rowe or Vanguard or Fidelity. But then when you want out, you sell it back to them. So there's a guaranteed buyer of it, meaning the fund. So if you want to get rid of your mutual fund, you just redeem it back to the company at the end of the day. And then we can drill down into the different types of mutual funds that work for you. So they have different ones. They have equity, which is pretty much equity, like buying stock. Now, wait, why would I buy a mutual fund versus investing myself? So like when I first started, I did ETFs and mutual funds because I was still learning and I didn't know how to look at stocks. I still don't. If you watch my portfolio, it sucks. But I pretend I can do this. So what happens is you buy into a mutual fund, you're instantly diversified because they have a massive portfolio of stocks. So that's one of the reasons you buy into it. It's diversification so that you don't have to worry about one stock shitting the bed. Another reason is that professional management I told you about, but that comes with higher fees. And the third one is liquidity. Like I just said, you can sell it right away to the company. If you want out, you're out that day. At the end of the day, guaranteed buyer from the company at fair market value, we think. Now, there are different types. What if you want growth? Maybe you buy an equity fund, or you want income, buy a bond fund, or some version of that. Or maybe you want some more specific stuff, which we can go into. That the whole point of a mutual fund is that they have so many different choices that you can actually pick what you want and get your performance without having to pick your stocks yourself. And that's the advantage of having this mutual fund. You have a professional stock picker. So let's say, so you do equity. Let's say you want to buy equity. So some of it's going to be based on market capitalization. The bigger the company, sort of, the less risk there is. So like large capitalization, what they do, all of these market cap is you take the stock price and multiply it times the number of outstanding shares. Like when you see the billionaires, you're like, oh, he's worth 150 billion or 200 billion. It's literally their shares times the market price. That's why you say, oh, they lost 30 billion. They made 30 billion. It's paper money. It's just the value of their shares. So that's what market cap is. So a large cap is a little safer, okay, more of a value company maybe. That's 10 billion or more, okay? The market cap is 10 billion or more. A mid cap is 2 billion to 10 billion. Small cap is 300 to 2 billion, and micro cap is under 300 million. Right before I first started, I'm starting like a fool. Large cap was $1 billion or more. Now that's literally small cap. Large cap used to be $1 billion or more. Now it's really small cap. That's how much the company has grown. So let's go into the different ones. Let's say you want equity because you're younger and you have a longer time frame. Let's say you want more growth. You'd buy a growth fund. These are companies that you're looking for capital appreciation. They're generally riskier than other types, but they have potentially higher returns. So growth stocks, your growth funds are more like high PE companies. Maybe they're not as established. They're riskier, but you're thinking there's a bigger upside. Maybe like tech firms, stuff like that. A value fund, basically these are strong companies. They're less risky. They're more about getting income than capital appreciation. Growth is more about appreciation. Value is more about the income. They pay dividends or whatever it is. They're undervalued, like they're out of favor companies. Like I always think, like I look at the airlines during the beginning of COVID, they were undervalued, strong companies, but nobody was flying. So undervalued, maybe they were by then. You will get some growth, but it's more about the income and the dividends than the growth. Now, an international fund is literally investing in companies. This fund only invests in companies outside the US, okay? International, not the US. A global fund invests in companies that are in the US and the outside. So international is just the outside the country. Global is inside and outside the country. So again, international is just outside everything but the US. Global is everything, including the US. Now, emerging market funds, those are like smaller companies. I say that every time. Smaller countries that are just building. So they're very risky. We think of like Asia, Latin America, Eastern Europe, Middle East, Africa, stuff like that. Those are all like developing countries, high risk, high reward. Now, remember, I said they're all diversified, right? So when you buy into these funds, they're diversified across a broad swath of companies. So we can narrow that down and take a little more risk and do a sector fund, like maybe with a tech fund or a healthcare or energy. We're specifically mostly in those sectors. So again, great high growth. And if you like that, if you think like tech is going to be big, you do a sector fund, you have a better chance of making money, but you also have a pretty high chance of losing. So it's out, the gains they're going to be pretty big, but the risk is big too. That's all about, those are equity. We'll come back to other ones. So remember, I said you can get in and out of mutual funds very easy, very quickly, so they're very liquid. However, there's a type that you can't, called an interval fund. An interval fund, you can only sell on certain dates. And the reason they do that is they buy more illiquid stuff. So again, normally mutual funds, you can sell, my voice is cracking like Peter Brady. Normally mutual funds, you can sell the day of, but a day of, at the end of the day, guaranteed buyer by the mutual fund. An interval fund, you can only sell on certain dates because they buy more illiquid things, so they can't sell the stuff to pay you as well. So interval funds have a liquidity issue that you can only sell on certain, like once a month, once a quarter, whatever it is. Either way, you cannot sell it any day you want. So you have to make sure that you're not in a need of money. So most mutual funds, liquidity is not a problem. Interval fund is. So if you have someone who may need money on a quick basis, need liquidity, that's not the choice, nor is a BDC. I mentioned it, a BDC, a business development corporation, is a fund that buys small and medium-sized companies to bring them public, like a PE firm. They take high risk, very small companies, high risk companies, and buy them and hope that they go up in value, okay, a lot. So they're very risky, so they're not very liquid at all. The next type of person is someone who wants income. Okay, now income is getting paid, right? I get paid, pay me, show me the money, fuck you, pay me, stuff like that. So bonds, so they're going to invest in bonds or preferred. So understanding what a bond is. A bond is when, like if you remember Mr. Wonderful in Shark Tank, a bond is when an investor lends money to a company and the company pays them on like every 6 months or every year, whatever it is, and until it matures, and then they pay them back the money. So you lend me $1,000, I'm going to pay you $50 a year for 30 years and then give you $1,000 back. That's a bond, okay? That's for income. You would buy that for income. So bond funds invest in those. So bond funds invest in bonds. That makes sense. Fixed income funds, stuff like that. Fixed income means that you're getting paid the same amount, on a fixed basis. The problem with that is there's a lot of inflation risk. Inflation risk is as prices go up, you're still getting the same amount of money, and the value of your money is worth less. They also have interest rate risk. As interest rates drop, that's a good thing, so your bond goes up. But if the interest rates rise, you're still getting paid that lower rate, and it's going to be worse for you. So again, a bond, if interest rates rise, your bond goes down in value. That's bad. So if you buy a bond fund, it's a little less because they're trading the bonds in and out, so they can offset a little bit of those risks. Not really inflation risk. They can't do much about it. But interest rate risk, buying an income fund, bond fund, can mitigate some of the interest rate risk because they can trade in and out of the bonds. And what they can do is they can buy new bonds with a higher coupon as it goes on. So buying a bond on your own, you have interest rate risk. That if rates go up, the value of a bond goes down because it's only still paying. Let me do it this way. You buy a 5% bond. Rates go to 7%. Right? Rates go to 7%. These bonds are paying 7%. You're only still getting 5%. Your bond is not as attractive, so it'll drop in price. That's interest rate risk. Bond funds will actually buy multiple bonds, and they have some maturing at all times. So when rates go to 7%, they will take some of their money and buy 7% bonds. So you're getting some 5%, some 7%. So it lessens the interest rate risk when you buy a bond fund. That's why you diversify. And that's why you buy bond funds. So let's talk about the different types based on the issuers, okay? So let's see. So we issue a bond. Who's the safest one? Yes, the federal government. The U.S. government will not default. Hopefully not. As I say, if they default, your bond's the least of your worries. You're going to be hiding in your basement, with cans of spam. So a U.S. Treasury bond fund, a Treasury fund, invests in government bonds and notes. They're usually more than 3 years, okay, because they have to pay income, okay? So you're getting, if you see safety and income, treasuries or treasury bond funds. If the person's rich, now what are rich people afraid of? Yeah, losing their money, but they're also afraid of paying taxes. So muni bonds, which what's cool about muni bonds, which are issued by state and local governments, you don't pay taxes on that income. They pay income and you don't pay taxes on it. So rich people really like these. So a muni bond fund, literally, it buys just muni bonds, okay? And those muni bonds kick off tax-free income. So rich people buy munis, poor people buy corporates. That's what I say all the time. So if you're a rich person, you buy munis because you're going to get income that is tax-free. And again, the mutual fund spreads out the risk. A third type is a corporate bond fund. These are high credit rating bonds, AAA, AA, and the income is great, but you are paying taxes on it, but it's buying all bonds by corporations. So that's a corporate bond fund. Then we have a high yield, okay? High yield is like speculative. Those are bonds from companies that are not as safe. They have a higher risk of default. And whenever you have a higher risk of something, remember, in this business, the more risk you get, the more rewards you should get. So if you take on higher risk by buying high yield bonds, you're going to get a greater return, but you are taking bigger risk of default, of them not paying you. Okay. A mortgage fund buys mortgage-backed securities. As you pay your mortgage every month, the banks take the money and packages it up and makes this mortgage-backed security where people who invest in it get monthly income. Mortgage funds buy those things. So you're going to get like monthly income, maybe more, maybe less, but you should be getting monthly income, and then your interest rates will affect that also. Then foreign bond funds are literally just investing in foreign companies or foreign companies and governments. So it's a foreign bond fund is investing in bonds of other countries or companies. If it's a global fund, U.S. is included. Again, international fund, not U.S. So those are the income funds, okay? Treasuries are for safety. Munis are for rich people. They don't pay income. They don't pay taxes. Corporates are a little more risky, but you get a bigger return because they're taxable. High yield, you get a much better return, but you're taking on more risk. Mortgage funds take in mortgage-backed security, income from people paying the mortgages, and foreign funds invest in foreign companies and countries. So what if you just want to park your money for a little bit, right? It's like maybe you need your money in 6 months or a year. You're starting a business or maybe buying a house in a year, maybe a year and a half. You don't want to take a lot of risk with a long-term bond or equity, so you can buy a money market. Now, retail people don't buy money markets. That's like T-bills, commercial paper, anything that's debt under a year. So instead, you'll buy a money market fund. A money market fund invests in products that are a year or less, very safe. It's literally to park your money. The NAV never changes. It's always like $1. Nothing changes on that, okay? So a money market fund is literally for short-term parking your money. If you need to do a deal or you need to pay for something in 6 months or a year, you do money market funds. So now we have like kind of in between this all. So we have hybrid funds. There's a balanced fund. So hybrid funds are ones that do both stock and bonds and stuff like that. They mix between the two. So a balanced fund is going to have stocks and bonds, and they set the percentage, like it's 60% equity, 40% bond, or 60%, whatever it is, it's a balanced fund, and they will always try to keep that ratio of 60-40, 40-60, whatever it is. So it's a balance. It kind of mitigates some of your risk too, because it spreads it out among both stocks and bonds, and that's a good thing. Then we have a target date fund, okay? A target date fund is like, okay, we assume that you're going to live, you say you want to get your money in 30 years. It's going to be more equity in the beginning and less debt. And as we get closer to that target, it's going to go more debt and less equity. And then within a year or two, it's going to be basically mostly debt and very little equity. So the point is, you can be aggressive or conservative. Like you can be much more aggressive, okay, on in the beginning part because you need to get equity. So let's say you're 25 years old and you're going to retire at 60. So you buy a target fund. It's going to be almost all equity and a little bit of debt. And then you turn 30 little less equity, a little more debt. 40, then when you turn 50, it might be 50-50. Then it goes 60-40, debt to equity. The older you get, the more debt you take, okay? Because it's safer, it's less risky. I don't do that. I'm a moron. I have basically all equity. But the point is, the older you are, the more conservative you have to be. So you have to buy more debt. But the risk here is that near the end, like when you're near the end, I mean, we're not dying, you're going to retire. If you do a lot more debt, you take on more inflation risk. Because remember, you're getting a fixed number, but prices go up and up and up like crazy, especially the year after COVID. It's crazy. Well, I've talked before about a sector fund. It's like a specialty into a specific sector of the thing. There are two others that are considered specialty funds that are very similar. In ESG or social responsible. They're obviously they want to make money, but they're much more about environmental, social, and governance criteria, gender equality, carbon emissions, ethical. So you're investing most like ethical. They won't invest in tobacco, right? Or like Monsanto or war things. They will more, basically it's more following the ethics or morality of the investor. It became really big right after COVID, and then it kind of died a little bit like every fad. I'm not saying it's not good. It is fair to do it. And if that's what you believe in, boom, do them. That's why they created this, for those that want to they want to invest ethically. You do an ESG fund. Okay. Then we have a commodity fund. A commodity fund literally just buys precious metals. Gold, silver, platinum, stuff like that. And maybe other things like gas, corn, wheat, hogs. All commodities are like things that I don't even explain what a commodity is, but it's like precious metals, gas, hogs, corn, wheat, orange, frozen concentrated orange juice, if you remember from trading places. Those are all commodities, okay? And they're going up and down like crazy, but they're a great hedge against inflation. I don't know if you hear my dog growling at me. Okay, not me, they're playing. You can really drill down in this stuff and go deep into like ultra short duration, but it's like overnight, all these crazy things. But the one I'm going to bring up is called a special situation, okay? A special situation fund is like they invest in companies that are either going through bankruptcy or takeovers or waiting for some approval from a regulatory. They are special situations, high risk, high reward. You might make a lot of money, but you might as well be horrible. Okay. So I gave you, blurry, a much better look when I'm blurry. It's awesome. So look, obviously you can go much deeper than this than I did. I wanted to give an overall view because most people will fall into the categories I just said. So look, if you're younger, you're going to do more equity. If you're older, you're going to do more debt. If you make a lot of money, you have high risk tolerance, maybe you do the small caps, the sector funds, aggressive growth, stuff like that. So you can measure, you can actually move. Remember, if you have a 401k or something, you can put a little bit in each type of fund to spread it out. And then as you get older, kind of maybe more conservative or just roll the dice. So there's a lot of ways to invest in mutual funds, and they're good, they're solid. They're a great way to invest if you're still trying to figure out how to do the market. You buy the mutual funds, at least you're in the market, you're growing, you have a professional manager while you do research and try to figure out what you like or don't like. It's a fun way to watch your portfolio go up or down. There it is. Okay, so I hope that helps with mutual funds a little bit. I hope that I didn't describe what a mutual fund is, but I'll put a link here that describes what they are because I do it for my Series 7 stuff. If you are taking the Series 7 and you want help, please check me out on YouTube live. I do a live Q&A. It's like a party, okay? Lots of music and fun and questions asked every Tuesday and Thursday night, 8:30 p.m. Eastern on my channel, Capital Advantage Tutoring, which is where you're seeing this anyway, I think. Anyway, have a good night. Wash your hands, and may the force be with you.